Welcome to the Deep Dive. Today, we're getting into the nitty-gritty of ACC Limited's latest quarterly results.
That's right. The first quarter of fiscal year 26, ending June 30th, 2025.
Exactly. We've got the official reports, the company's media release, and we've been thinking about what it all really means.
Our goal, as always, is to cut through the jargon.
Yep. What actually happened? Why should you care? And what does it signal for the building material space?
And they're touting robust quarterly performance and their highest ever volume.
So is it just spin, or is there real substance there? Let's dig in.
Okay.
So let's start with those headline numbers for ACC this quarter. What really jumped out at you first?
Well, the big one is revenue from operations. It climbed to 6,087 crore.
Wow, okay. How does that compare?
That's a solid 17% increase compared to the same quarter last year. Pretty significant for a company this size.
17%, yeah, that's strong. What about the bottom line? Profit after tax.
That was a bit more modest. PTEC came in at 375 crore, which is up 4% year over year.
Okay, 4%.
But what's quite interesting is the operating EBITDA. That hit 778 crore.
And how much growth is that?
That's a 15% increase year on year, so strong growth there too.
Right, a 17% revenue jump and 15% EBITDA growth.
Yeah.
Sounds good, but I did see the operating EBITDA margin actually dipped slightly, from 13.1% down to 12.8%. What's going on there?
Yeah, that's a good catch. That slight dip, well, it suggests they might be really pushing hard on volume and market share, maybe accepting a tiny bit less profit per ton to drive that top-line growth.
So sacrificing a little margin for more overall profit.
Seems like it. The fact that the absolute EBITDA grew strongly shows the underlying operations are performing well alongside that revenue surge. But yeah, it's definitely a balancing act you'd want to keep an eye on.
Makes sense. And for investors, what about earnings per share?
Diluted EPS, that also saw a small rise. It's 19.9 for the quarter, up from 19.2 last year, so about 0.7 increase.
Okay, so strong top line, decent profit growth, maybe a slight margin squeeze for volume. Now the big question, how do they actually achieve that big revenue jump? What were the engines?
Right. It really boils down to two main things: selling more and selling smarter.
Okay.
On the volume side, they hit an all-time Q1 record for cement and clinker sales. We're talking 11.5 million tons.
11.5 million tons. That's a lot.
It is. It's a hefty 12% increase compared to last year's Q1. And their ready-mix concrete RMX that saw good growth too, up to 0.83 million cubic meters.
So pure volume growth was a big factor. What about the selling smarter part?
Yeah, that's about the product mix. They really push their premium products. Those now make up 41% of their trade sales.
41%. That's quite high.
It is, and it's up 7 percentage points from last year. So they're not just selling more cement, they're selling more of the higher value stuff.
And that focus on premium, that lines up with their whole integrated strategy, doesn't it?
Absolutely. It fits right in with the CEO talking about premium sales and operational excellence. It's clearly a core part of the plan.
Okay, so selling more and selling more premium. What about physically expanding? Any new plants or strategic moves on the ground?
Oh, definitely. They've been busy. They commissioned a new grinding unit, 1.5 million tons per annum capacity at Sindri. That's a brownfield expansion, meaning adding to an existing site.
Right, Sindri. More capacity.
Exactly. And crucially, they really beefed up their ready-mix concrete network, added 12 new RMX plants just this quarter.
12. Wow. How many does that make total?
That brings them to 114 plants across the country. It's a clear push to be closer to the customer, capture that local demand.
Makes sense for concrete. And I saw something about their subsidiary, AMRL, ACC Mineral Resources Limited. What's their role?
Yes, AMRL. That's more about the long game. Last year, AMRL bought 15 smaller companies.
15. For how much?
The cash was about 298 crore, and ACC also provided AMRL with around 380 crore in intercorporate deposits.
So basically internal loans to fund these acquisitions.
Pretty much. These acquired companies hold land, potential spots for future factories, and mining rights. It's strategic land banking.
And they're still funding it.
Yep. In this quarter, ACC put another 71 crore into AMRL, this time through optionally convertible debentures, or OCDs.
OCDs.
Yeah.
Right. So that gives them flexibility, fund a land grab now, decide on equity later.
Exactly. It's a smart way to finance long-term expansion plans without committing fully upfront. Gives them options as those future sites develop.
That really is looking ahead. So putting it all together, the new capacity, the RMX expansion, this AMRL land strategy, how well does this position them, do you think, to actually capitalize on India's infrastructure push? It's a competitive market.
That really is the million-dollar or maybe billion-dollar question. Like, it shows clear foresight. They're not just reacting, they're proactively building out the capacity and the supply chain ahead of the demand they anticipate.
Getting ready for the boom.
Essentially, yes. Investing in Sindri, dotting the map with RMX plants, securing land via AMRL. It's all about being ready to supply that expected growth in housing and infrastructure. It does, of course, mean significant capital spending now for future returns.
Right, a big bet, but a strategic one. Okay, let's switch gears slightly. Let's talk costs. Cement is super capital intensive. Managing costs is critical. How did they do on efficiency this quarter?
They actually made some pretty impressive gains here. Cost reduction was clearly a focus.
Like what, specifically?
Well, kiln fuel cost is a big one in cement. They managed to cut that by 10%.
10%? That's huge. How?
It came down to 1.56 per thousand kcal. They did it by optimizing their fuel mix, using more low-cost imported pet coke, better use of captive coal, plus finding synergies with their group companies. It wasn't just one thing, but a combined effort.
Yeah, a 10% cut in your main energy cost that flows straight to the bottom line. Shows real operational discipline.
Absolutely. It's not just tweaking, it's a fundamental improvement. And it wasn't just fuel. Logistics costs also came down.
Okay, how much there?
Down 5% to 972 per ton. Again, driven by efficiencies, things like improving direct dispatch by road, getting that up by 2 percentage points to 69%.
So more going straight from plant to site, skipping warehouses.
Effectively, yeah. And they also shaved off 1% from their road PTPK, that's cost per ton per kilometer. Now, 1% might sound tiny.
But when you're moving millions of tons.
Exactly. That 1% drop to 4.15 per ton per kilometer adds up to very significant savings overall. It's about sweating the details on logistics.
Really squeezing out those efficiencies. Okay, so costs under control. What about the green side of things? Sustainability is massive for this industry now. How's ACC performing?
They're making pretty strong progress there, too. Green power usage saw a big jump this quarter.
How big?
It increased by nearly 12 percentage points, 11.9 pp to be exact. So now 26.2% of their total power consumption is from green sources.
Okay, over a quarter now. Where's that coming from?
It's a mix. They boosted their waste heat recovery WHRS power by 4 percentage points, so that's now 13.9%. And solar power usage jumped almost 8 points, up to 11.3%.
And they have targets for this, right?
They do, and quite ambitious ones. They have a clear plan with investments lined up to hit 60% green power share well before their original FY28 target.
60%. That's a serious commitment. Now, thinking bigger picture, obviously being greener is good environmentally, but how does this focus help them strategically? Does it make them more resilient or attract different investors?
That's a really important angle. It's definitely more than just corporate responsibility. Firstly, using more green power, especially self-generated like WHRS and solar, makes them less vulnerable to volatile fossil fuel prices. That builds operational resilience.
Right, less dependency on coal or petcoke prices.
Exactly. And secondly, their credentials here are quite strong. ACC and Ambuja, their parent company, are apparently among only 4 big cement makers globally to get their net zero targets validated by the Science-Based Targets Initiative, the SBTI.
That's a significant validation.
It really is. That kind of external validation, plus things like launching digital sustainability reporting, getting environmental certifications for their products, it absolutely makes them more attractive to ESG-focused investors and partners. It's becoming a real competitive differentiator, not just nice to have.
Okay, interesting. Now let's peel back one more layer. Let's look at the notes to the accounts, the stuff that sometimes reveals longer-term impacts or ongoing issues. Anything stand out from past financial adjustments?
Yeah, digging into the notes is always revealing. What's clear is how past events, good and bad, can ripple through the financials years later.
Like what, for example?
Well, in the previous financial year, FY25, they booked a huge income over 636 crore from an excise duty refund. That related to a dispute going all the way back to a Supreme Court decision from 2016.
Wow, it took that long to resolve.
Yep. But on the other side, in the same year, they also had to take a big impairment charge, over 207 crore, for some old, non-operational clinker units that just weren't viable anymore.
So, cleaning house a bit.
Seems like it. They also had a decent gain from selling some surplus land in Thane, and they reversed some old tax and interest provisions after favorable rulings. So you see this mix of cleaning up old issues, both positive and negative, that shapes the current balance sheet.
Right. Understanding that history is important. What about things that are still ongoing? Any major legal headaches we should know about?
There are definitely a couple of significant ongoing legal matters. It's crucial, like you said, for anyone looking at the company to be aware of these.
Really?
The main ones involve the Competition Commission of India, the CCI. There are two big disputes. First, a penalty of nearly 1,150 crore imposed back in 2016 for alleged cartelization.
Over 1,000 crore. That's massive. What's the status?
Their appeal is with the Supreme Court, and there's an interim stay on the penalty, but it's still hanging over them. The second CCI case is smaller, about 35 crore from 2017 for alleged collusive bidding. That appeal is before the NCLO.
Okay, so two big competition law cases still unresolved.
Yeah.
And the company's stance.
They state, based on legal advice, that they have a strong case in both instances and haven't made any financial provision for these penalties or potential interest in their books.
So management is confident, but carrying potential liabilities that large, even if disputed? What's the risk perspective? Auditors usually flag these, right?
Absolutely. Auditors highlight these as contingent liabilities in their review reports. While management might be confident from an investor or analyst perspective, these are significant potential financial risks. A negative outcome, even if considered unlikely by the company, could have a material impact down the line. It's just something you have to factor in as an uncertainty.
Good point. Any other ongoing disputes?
There's one mention involving their subsidiary, AMRL, settling a dispute over a canceled coal block, and an ongoing tussle with Karnataka's mining department over limestone royalty calculations. Again, the company believes it has a strong case and hasn't made provisions.
Okay, so a few legal threads still dangling. Let's shift focus now towards the market and the future. How is ACC positioning itself? What are they doing on branding and digital?
They seem to be doing quite well on the branding front. For the third year running, TRA Research ranked both ACC and Ambuja as India's most trusted cement brand. That's pretty good recognition.
Consistency matters there.
It does. They also picked up an Environmental Excellence Award, which ties back nicely to their sustainability push. And strategically, they've partnered with 3DI, the real estate developer's body.
Ah, interesting. To do what?
The stated aim is to promote sustainable urban construction. It's a smart move to deepen their B2B connections and push their greener products directly to developers.
Makes sense. And are they active in marketing to the wider public?
Very much so. They launched a new digital ad campaign for their premium range, apparently got over 125 million views. Plus, they did strategic brand placements during the IPL cricket tournament, reaching a huge audience, over 600 million people.
So definitely visible. What about using digital technology inside the company? Is it just marketing glitz? Or are they actually transforming operations?
No, it seems to be much deeper than just marketing. They're implementing quite a few internal digital initiatives, too.
Such as?
Things like DigiPin for standardizing addresses. Sounds small, but can really help logistics. They've rolled out SAP Funds Management for better budget control. They're enabling remote access to plant control systems, which is a big step.
For monitoring and maybe even control from afar.
Potentially, yes. Plus, there's a big master data management project underway and efforts to strengthen their operational technology, or OT, cybersecurity. These are foundational changes that aim for better efficiency, data use, and security across the board.
Okay, so a real push on digital internally as well. Given all this, the expansion, the efficiency drives, the branding, the digital put, what's their take on the market outlook? Are things looking good for the cement sector?
The outlook seems pretty positive, yes. According to their release, cement demand was strong in Q1, growing about 4%. That was driven by good macroeconomic factors and continued demand from housing and infrastructure.
Yeah, looking ahead.
They expect Q2 to remain strong as well. For the full fiscal year, FY26, the forecast is for overall cement demand in India to grow somewhere between 6% and 7%.
6 to 7% growth for the whole year. What's driving that?
It's expected to come from continued demand in affordable housing, both rural and urban, plus increased government spending on core infrastructure projects and growth in the commercial sector, too. So pretty broad-based demand drivers.
Right. What really strikes me here is how they seem to be tackling things on multiple fronts simultaneously. You've got the traditional brand building and market engagement, but also this serious investment in digital transformation, both internal and external.
Exactly. And if you connect that back to the strong industry growth forecast you just mentioned.
Yeah, this integrated approach, physical expansion plus digital smarts, it really seems to position them quite well to capture a good slice of that demand, doesn't it? Especially as they expand into new areas and keep innovating.
I agree. It's not just about keeping up with current demand. It feels like they're trying to build a more resilient, adaptable, future-ready company that can leverage both its physical scale and its growing digital capabilities.
Okay, so let's try and wrap this up. To recap, ACC Limited's Q1 FY26 showed really robust growth in revenue and volume, pretty impressive cost-cutting through operational efficiencies, and a clear, validated commitment to sustainability.
Right, alongside strategic expansion, both in capacity and RMX footprint, and that strong push into digital across the business, all geared towards meeting what looks like continued strong market demand.
So here's a final thought for you to consider. We see ACC aggressively expanding, pushing green initiatives, focusing on premium products, and transforming digitally, all while navigating some complex legacy legal issues. How might this combined strategy actually start to reshape the broader building materials sector here in India?
That's the big question.
Yeah, think about how companies like ACC balancing this drive for growth with uh, responsible practices and digital savvy aren't just building physical structures. Are they also perhaps constructing new standards for the entire industry, something to chew on?